If you hold Bitcoin on an exchange, this concerns you, because 620,000 Bitcoin appeared inside one. Not on the blockchain, not through mining, not through a hack. They were typed into a system. Balances changed, sell orders appeared, and the market moved. Price fell. But the blockchain did nothing. No new supply, no broken rules, no emergency update, just numbers. And those numbers were enough to move price. So here's the uncomfortable question. If Bitcoin's supply is untouchable, why is its price so easy to disturb? This happened in South Korea, on a major crypto exchange. The exchange later described it as a payout error. A promotional reward, meant to be paid in Korean won, was mistakenly entered as Bitcoin. User balances suddenly showed enormous amounts of Bitcoin. Some of those balances were converted into sell orders, and the exchange's market price reacted immediately. Most of the balances were later recovered. There is no public evidence that this was deliberate manipulation. But this story is not about intent. It is about structure. Most people believe they are trading Bitcoin itself. They imagine coins moving across the blockchain with every trade. In reality, that is rarely what happens. When you buy Bitcoin on an exchange, the blockchain usually does not move at all. Your balance changes inside a centralized database. That database is owned and controlled by the exchange. Your Bitcoin becomes a ledger entry. Ledger entries can be created internally. They can be modified. They can be frozen. They can be reversed. This is how most exchange trading works. Bitcoin's monetary policy is decentralized. Its supply schedule is fixed and transparent. No company can increase Bitcoin's total supply on-chain. That is supply sovereignty. But price is different. Price does not live in the code. Price lives inside order books. Order books are centralized systems. They are operated by private entities. They determine which orders are matched and at what price. If enough sell pressure appears inside an order book, the price falls. It does not matter whether those balances were on-chain or internal entries. What matters is how the order book reacts. Sovereignty means ultimate control over a system. Bitcoin has supply sovereignty. No central authority can inflate it arbitrarily. But does Bitcoin have price sovereignty? Price sovereignty belongs to whoever controls price formation. Price formation happens inside exchanges. This incident showed that internal ledger balances were enough to move price, not miners, not nodes, an exchange interface. If a system can influence price through internal mechanisms, that system holds price power. Price power is a form of economic sovereignty, even if unintentionally, even if temporarily. We say Bitcoin is trustless, but we trust exchanges every day. We trust their balances. We trust their order books. We trust that the price we see reflects reality. But price is produced inside centralized systems. There is no evidence that this single incident caused global Bitcoin declines. Global markets are shaped by many forces: futures markets, liquidity flows, leverage, macroeconomic shifts. But this event forces a deeper structural question. If Bitcoin is decentralized, why is its price discovered in centralized arenas? If the protocol is sovereign, who holds sovereignty over price? 620,000 Bitcoin appeared. The blockchain did not blink, but the market moved instantly. Maybe Bitcoin is not the fragile part of this system. Maybe the fragile part is the mechanism that shapes its price. And maybe the real question is not who owns Bitcoin, but who owns its price.